here are 4 reasons why chasing stocks will not help you stay safe from inflation. Number one, a lot of stocks have debt. And if you're a company and you have debt on your balance sheet, and as many corporations have record amounts of debt on their balance sheets now, thanks to them taking on more and more debt during the low interest rate season that the Fed kept us at for so long, then as interest rates go higher, that's going to cost companies, publicly traded companies, a lot more money to borrow and service debt. That'll end up crushing their profitability of the corporation. And that means it's going to crush, that's right, the value of the stock market. So the second reason is that stock buybacks can no longer be financed. Prices are going to collapse, and many companies are going to have to sell shares that they bought to keep their price up as much as possible because many stock corporations used debt to buy their own stock. Just a few years ago, just in the glory days of the low interest rate world of just a few years ago, companies would borrow money and then buy their own stock. It's called a stock buyback to kind of push up their stock price. And this is sort of a major push over the bull market over the last 15 years. And that's really pushed stocks into record territory. Now that interest rates are going up, corporations will no longer be able to buy their own stock. In fact, they're going to have to sell their own stock as they go further and further into debt to make good on these larger debt payments. And all this selling of stock on the market is going to have a downward pressure on stock market prices. This is going to be instead of a stock buyback, it's going to be a stock sellout. And many stocks are going to be dumping their market shares back onto the market where no one is really in a position to buy it. Third reason why I think the stock market is going to be particularly pummeled by higher interest rates is that publicly traded corporations have to deal with customers that also have a lot of debt on their balance sheets too. So as customers pay more and have higher interest rates to service their own debt, customers will have less money available to purchase goods and services that these corporations are selling, which just further pushes down the profitability of these corporations. As their earnings go down, their earnings collapse, and as their interest rates go up. Remember, stock prices are a function of future earnings. Basically, it's the expectation. What is the stock price? A lot of people ask me, how do you pick a stock price? Well, the rational answer is it's basically the expectation of future dividends that you might receive by owning ABC stock, calculated in today's money, in today's dollars, a present value. So future dividends are going down because earnings are coming down. And that means the stock price will be coming down, which means your 401k value will be coming down, which could be disastrous for many people's retirement accounts. Now, number four reason, the last reason, just comes down to simple math. Remember how I said just a second ago that we get the stock price from a simple math formula. When you compute the present value of future earning streams from a company, you have to discount it by an interest rate. That's part of the formula. You discount that price by a certain specified interest rate. That's how you get the stock price. Now, the lower the interest rate, the higher the present value of those stock future earnings. Now, as the Fed is raising interest rates, they're going to be diminishing the value of those future earnings from these different stock companies. So not only are corporate earnings collapsing, but the present value of those remaining diminished stock earnings are also collapsing. So rising interest rates actually delivers a double punch to the stock price. Now, those are 4 really good reasons, but here's a bonus reason. As interest rates again are rising, this is hurting the overall economy, and it might even push the economy into a long-lasting recession. Now, recessions bring with them a huge wave of problems, but one of the big ones is job losses, which, with people losing jobs, they're going to have no money to spend. And when customers don't have money to spend, that's going to have, again, negative impact on corporations that have publicly traded stock prices on the stock market. So stock earnings are going to just implode for all sorts of reasons. Many companies are just not going to be able to handle the debt that they're carrying, and others are going to be unable to pay their debts and they'll go bankrupt. And don't forget that when one company goes bankrupt, it can no longer support the company that it owed money to. So the lender then becomes financially insolvent and it goes out of business as well. Now, all of this creates systemic risk throughout the entire economy.